Welcome to today's Explainer. We are jumping right into a really fascinating foundational piece of work today, an overview of the VLAB volatility analysis documentation. If you've ever stared at the financial markets and thought they behave like some kind of chaotic, totally unpredictable storm, well, you're not entirely wrong. But here's the secret we're going to unpack today. Market risk is actually dynamic. It's not just this constant, flat line of uncertainty. There's a hidden structure inside that chaos. And by the end of this explainer, you're going to see exactly how analysts systematically measure and even predict that uncertainty. Okay, let's dive into this. Think of market volatility like weather patterns. That's the core metaphor we really need to keep in our heads today. We're essentially talking about financial meteorology here. Because when a storm rolls in, it doesn't just strike for 60 seconds and vanish, right? Storms cluster. In financial markets, a deeply turbulent trading day is very often a massive red flag, signaling that more turbulence is right behind it. And on the flip side, extended periods of calm usually suggest we're going to see continued stability. This whole concept is a total game changer. It transforms volatility from just being a scary word for risk into a remarkably powerful forecasting tool. So, here is our roadmap for today. First, forecasting the financial weather. 2, why volatility modeling matters. 3, 4 perspectives on risk. 4, the evolution of models. 5, the fundamental toolkit. And 6, advanced volatility forecasting. Let's start with part 1, forecasting the financial weather. First up, we have to shatter this illusion that market risk just stays exactly the same over time. Let's look at the basic building blocks of how this forecasting actually works in practice. The absolute foundational concept you need to grasp here is conditional volatility. See, older traditional risk measures used to compute a single volatility number by just throwing all historical data into a pot and weighing it equally. But conditional volatility models recognize something incredibly intuitive. What the market did yesterday, or even last week, is vastly more relevant to what it's going to do tomorrow than what happened, say, 5 years ago. It's what allows risk management to actually adapt in real time to shifting conditions. And that idea feeds perfectly into the concept of volatility clustering. This is the phenomenon where large price movements, and we're talking whether they're surging up or crashing down, tend to be followed by more large movements. What this actually means for you is that even if the actual direction of the price is a complete mystery, the turbulence itself is predictable. It's like if you know the waters are going to be choppy, you can prepare your ship, regardless of which way the wind happens to be blowing. Completing our core triad of concepts is mean reversion. You can think of this as the market's psychological anchor. So while volatility clusters in the short term, over the long run, it inevitably reverts to the mean. Even the wildest financial storms eventually just run out of energy and subside. And interestingly enough, those unusually long, boring periods of calm, they always eventually wake up and experience renewed activity. This specific dynamic is exactly what allows investors to actually do long-term planning without completely panicking every time a storm rolls in. Moving right along to Section 2, why volatility modeling matters. It's one thing to understand all this in theory, but I really want you to consider the real-world consequences here. Because what happens when we get the financial weather forecast horribly wrong? Well, we saw it. 2008 happens. The 2008 financial crisis is the ultimate cautionary tale for this stuff. Major financial institutions were relying heavily on historical averages rather than the dynamic models we were just talking about. They were essentially using a static thermometer to measure a rapidly evolving hurricane. And because they failed to anticipate that extreme clustering of losses, the entire system broke down. In fact, a lot of our modern regulatory frameworks exist today precisely because those static risk measures proved so incredibly, dangerously inadequate. But beyond just avoiding total catastrophe, dynamic volatility modeling is literally the bedrock of modern finance. Take portfolio managers, they use it every day to figure out exactly how much risk to accept to hit their target returns. Traders use it constantly for derivatives pricing. I mean, the famous Black-Scholes formula assumes constant volatility, sure, but real practitioners actively incorporate dynamic forecasts to hunt down mispriced options. It's also legally required now. Basel III banking regulations mandate these exact calculations for capital reserves. And finally, multinational corporate treasurers use these models to hedge their bets against wild currency and commodity swings. It's everywhere. All right, Section 3, 4 perspectives on risk. Volatility actually means entirely different things depending on where you sit in the financial ecosystem. Let's look at the different players relying on these weather forecasts. First up, we've got the ultimate defensive players, risk managers. To them, volatility is a threat. Plain and simple. They're laser-focused on downside protection and worst-case scenarios. They want conservative estimates that prioritize catching extreme events, even if it makes their models slightly less accurate on a boring Tuesday. But contrast that with portfolio managers. They're playing offense. They look at volatility as the price of admission for opportunity. They are balancing forecasts against expected returns, and they want models that are super precise during typical market conditions so they can optimize performance.
Then you have options traders. For this crowd, volatility isn't just some risk metric on a dashboard, it's the actual product. It is a tradable commodity. They buy when their models say options are cheap relative to expected future volatility, which means they need models that respond instantly to super subtle market shifts. And then, way on the far end of the spectrum, we have the academic researchers. They're the architects building the foundation. They prioritize theoretical elegance, really rigorous statistical properties, and empirical fit, basically ensuring that the math actually holds up to intense scrutiny. Which brings us to Section 4, the evolution of models. These predictive tools, they didn't just appear out of nowhere in a vacuum. They were forged in crisis. Necessity really drove the innovation here. Back in the 1970s, fixed exchange rates collapsed and inflation just went completely wild. Fast forward to 1982, and Robert Engel creates the groundbreaking ARCH model to mathematically capture that volatility clustering we talked about. That was such a massive breakthrough, it actually earned him a Nobel Prize. In 1986, Tim Bullerslove generalized that into the GARCH framework, which honestly still dominates today. But then, the 1987 crash hit. That taught us real quick that bad news spikes volatility way harder than good news, which led straight to the creation of asymmetric models. And, of course, the big collapses, like long-term capital management in '98 and the 2008 crisis, those completely forced the industry to aggressively test for tail risks and extreme outlier events. Section 5, the fundamental toolkit. Now we're going to crack open the VLab toolkit and look at the actual mathematical models that handle standard volatility analysis. What is so fascinating about this evolution is how each new model basically steps in to solve a specific blind spot of the previous one. We start with that classic 1986 GARCH model. It's simple, it makes a great baseline, but it's symmetric, meaning it treats a massive market crash and a massive market boom as having the exact same impact on future volatility. And we all know that is definitely not how human panic works. So models like EGARCH and JJR-GARCH hit the scene in the early 90s to capture what we call asymmetric shocks and leverage effects. They specifically, mathematically, account for the fact that downside risk, bad news, creates significantly more future turbulence than good news. And then ARCH comes along to add even more flexibility for custom volatility shapes. Finally, Section 6, Advanced Volatility Forecasting. So when that fundamental toolkit just isn't enough to handle the sheer complexities of modern, high-frequency finance, analysts pull out the heavy machinery, specialized domain models. If you need to map out long-term structural regime changes in the overall market, you'd pull up a Spline-GARCH model. If you're dealing with high-frequency, intraday data where values physically cannot go below zero, you lean on the MEM framework. And remember those fat-tailed risks from the 2008 crisis? The GARCH student T model is specifically built to be robust against those heavy-tailed distributions. You know, those extreme, rare events that standard models just totally gloss over. Basically, every tool here is highly specialized for a totally unique financial environment. But here is the absolute crucial point. Reading through the source documentation, there's a very, very clear warning from VLab. You can have the most beautiful, mathematically flawless model in the entire world. But effective volatility modeling absolutely requires combining statistical rigor with practical human judgment. These models are systematic frameworks for processing massive amounts of information. They are not crystal balls. Truly successful application means a risk manager actually understands the blind spots and the limitations of the algorithm sitting right in front of them. Which leaves us with a pretty compelling thought to end on today. As these financial algorithms just keep growing more and more capable, digesting mountains of data at lightning speeds, how exactly will human intuition and judgment fit into a world dominated by automated forecasting? The math tells us the probability of the storm, but at the end of the day, it's the human who still has to decide whether to sail the ship. I highly recommend going and checking out the interactive tools on VLab. It's honestly wild to tweak those parameters and watch the forecasts shift in real time. Thanks for hanging out with me for this explainer, and hey, keep your eye on the financial weather.